What happens when the invisible hand of the financial markets becomes more powerful than the hand of politics? In 2025, the world witnessed a remarkable moment where the markets didn't just respond to policy, they overruled it. President Donald Trump, known for his bold economic moves, announced a new wave of sweeping tariffs on dozens of countries. This was intended as a declaration of strength, a signal that the United States was once again taking the driver's seat in global trade negotiations. But the markets weren't convinced. What followed wasn't a standard reaction. It was an uprising from within the financial system itself. The U.S. Treasury market, a cornerstone of the global economy, began to show signs of intense stress. Yields on 10-year government bonds spiked dramatically. Mortgage rates, corporate lending rates, and even car loan interest rates surged in tandem. Investors panicked. Confidence trembled. And then, only days after the announcement, Trump backtracked. The tariffs were paused. A shift in tone replaced the initial bravado. And when asked about the bond market, Trump replied simply, "It's beautiful now," but what had really happened? To understand the full picture, we have to examine a rarely discussed, yet immensely powerful group in the global financial ecosystem, the bond vigilantes. These are institutional investors who wield trillions in capital. They don't run for office. They don't need to. Their influence lies in what they choose to buy or sell. When governments act recklessly, spending beyond their means or creating instability, bond vigilantes react. They sell. And when enough of them sell government bonds, borrowing costs skyrocket. For a government, that means higher interest payments, tighter budgets, and immediate pressure to change course. In 2025, they made their presence felt once again. The sharp increase in yields wasn't just about Trump's tariffs. It was a response to unpredictability. Markets don't like surprises, especially when they come from the top. The bond market had already endured years of stress through the pandemic and the inflationary spiral of the early 2020s. But this time, it was different. The reaction was global. Japan's 30-year bond yield soared to levels not seen in over 2 decades. Britain and France experienced similar spikes. Even emerging markets felt the ripple effects. It was a coordinated recoil, a signal that global investors were ready to push back. And they did. In a matter of hours, hedge funds started unwinding massive leveraged positions in Treasury futures. Prime brokers, major banks that lend to hedge funds, tightened credit lines. Liquidity dried up. Bid-ask spreads widened to alarming levels. For those in the know, it felt eerily similar to the March 2020 dash for cash panic. But this time, there was no pandemic. No collapse of consumer demand. No war. The only trigger was a political decision, and the market's rejection of it. As the sell-off deepened, whispers began to circulate. Was this a deliberate move by investors to discipline policymakers? Were we seeing the return of the bond vigilantes? The term itself was coined in the 1980s. Back then, inflation was high, interest rates were volatile, and debt levels were beginning to mount. Investors who feared government irresponsibility responded by selling bonds, demanding higher yields in return for taking on more risk. The bond vigilantes were seen as a kind of market-based counterweight to political overreach. Today, their methods haven't changed. But the stakes have. The modern global economy runs on cheap debt. From households to corporations to entire nations, borrowing is baked into the system. Low interest rates have been the lifeblood of economic expansion for over a decade. So when borrowing costs rise sharply, even for just a few days, the consequences are immediate and widespread. And that's exactly what happened. In the days following the tariff announcement, mortgage lenders revised their rates upward. Credit card interest rates crept higher. Companies postponed debt offerings. Even major infrastructure projects were put on hold as cities and states re-evaluated their financing options. All because of a bond market revolt. And then, just as quickly, came the retreat. The White House paused the tariffs. Markets steadied. Yields fell. The panic subsided. But the message had been delivered. In a world where debt is the foundation of economic growth, those who control the cost of that debt hold immense power. And in 2025, they used it. But what does this mean for the average person? It means that your mortgage, your student loan, your small business credit line, these are all linked to decisions made far above your head. Not just in Washington, but in boardrooms, trading floors, and central banks around the world. It means that when investors lose confidence, the effects are not limited to Wall Street. They hit Main Street. They hit your street. So what can be done? Transparency is key. Predictability matters. When leaders make policy, they must consider how those decisions echo through the financial system. Communication with markets isn't optional. It's essential. And for all of us, understanding these dynamics is no longer a luxury. It's a necessity. The bond vigilantes may not appear in political debates, but they are part of the system. A system that can, and will, push back when the rules are ignored. As global debt continues to rise, and as economic uncertainty becomes the new normal, their presence will only grow stronger. In this story, there are no villains. Just cause and effect. Action and reaction. Power and accountability. If you found this video helpful, informative, or thought-provoking, don't forget to like, share, and subscribe. Your engagement helps us keep producing content that explains how the financial world really works. This video is for educational and informational purposes only. It is not financial, legal, or political advice. No individuals or institutions are being accused or targeted. Always do your own research and think critically.